Hello traders, you're welcome to this video. In this video, we are going to be discussing the commodity channel. We are going to be looking at how you can use this indicator to identify market trends. And we are also going to be looking at the crossover strategy using the CCI indicator. Okay, so first of all, we're going to be loading the CCI indicator to our chart. Okay, we're just going to use the default settings. All right, now the commodity channel index is a momentum based indicator that helps traders identify potential overbought and oversold conditions, as well as spotting emerging trends. So now we're just going to be considering how you can use the CCI to spot market trends. First of all, you need to understand how the CCI indicator works. Okay, the CCI indicator measures the difference between the current price and its historical average over a specific period. Okay, usually the 20 periods. What that means is this parameter here, you are the one to select the period that you want the CCI to work with. But we're just going to be using the default of 20. So based on the default settings, the CCI measures the difference between the current price and its historical average over 20 periods. If you want it to be 50, it becomes over 50 periods. Okay, all right. So now the values are plotted on a chart and the indicator oscillates above and below zero. We can see that we have the zero line here, okay, and then we have 100 level here, we have minus 100 level here. So high CCI values indicates values above plus 100. It suggests that prices are higher than the average, indicating an overbought condition, okay, above 100, between here and here, right? And then as for low CCI values, they are values below minus 100. It suggests that the prices are lower than the average, okay, that is between here and here. It indicates oversold condition. Now, how do you identify market trends? For a bullish trend, it occurs when the CCI consistently stays above the zero line. Can we see that this zero line is around the middle? The zero line is around the middle. So when you have the CCI indicator staying consistently above the zero line, it can indicate a possible bullish momentum. However, when the CCI indicator crosses above the plus 100, it signals a strong upward momentum. It signals a strong upward momentum, as we can see here that after the CCI crossed above the plus 100, just after that we had a bullish move. Initially the price was ranging, it was ranging for a while, and then after we had the CCI cross above the 100, we saw a bullish move. Now around this point, we can see that after the CCI crossed above the 100, we still had a bullish move for a while. It was more of a continuation of the bullish move that had already started. However, when the CCI begins to point downwards inside this oversold zone, it could show the weakening of that bullish move, a potential start of a new trend, which is going to be a bearish trend or possibly a pullback from the bullish trend. So when you notice that crossover, you might want to exit your bullish trade now, or your buy trade. So now for a bearish trend, it occurs when the CCI consistently stays below the zero line. You can see that the zero line is located here. When you have the CCI line staying consistently below that line, then it indicates a bearish momentum. Then when you find the CCI entering into the oversold zone, it could indicate a potential start of a bullish move. So you might want to watch out for the curving of the CCI indicator upward. Whenever that CCI indicator curves upwards, a possible bullish move is about to start. So you can consider exiting your bearish trade or your sell trade. Okay, so when you have the CCI indicator pointing upward within the oversold zone, you can consider exiting your sell trade. However, when you have the CCI pointing downwards below the zero level, then you can consider entering a sell trade. Okay. Now, in terms of the crossover strategy, the crossover points of the CCI can help with timing entries and exits in the following ways. Now, as for our entry signal, when the CCI crosses above the minus 100 from the oversold zone, when it just crosses above the minus 100, it indicates that bearish momentum is fading, which can be a signal to go long. So if you want to work with the crossover strategy, when the CCI crosses above the minus 100, it's a signal to enter a buy trade. Okay. Then as for a sell, when the CCI crosses below the plus 100 from above, it indicates that bullish momentum is weakening. Okay, so it signals a potential sell opportunity. So when you find the CCI crossing below the plus 100, you can consider entering a sell trade. Okay, now as for our exit signals, when you want to close your long positions, you can consider doing that when the CCI crosses back below plus 100. Remember that we are already in a buy trade when the CCI enters the plus 100, right? Then when you want to exit your buy trade, you can consider doing that when the CCI begins to cross down below the plus 100. So had it been we had entered a buy trade around here, when the CCI crossed above the minus 100, we would have entered somewhere around here, right? And then when the CCI began to cross back downwards below the plus 100, we would have exited somewhere around here, right? So we would have caught somewhere around 276 pips. Okay, so that would have been a good catch. Now, as for closing the short positions, when the CCI crosses back above the minus 100, remember that a sell signal occurs when the CCI crosses below the plus 100. Yeah, that is below the overbought level. That's a sell signal. So as for exiting your sell, you can do that when the CCI begins to cross back upwards from the oversold zone. Okay, so when you find the CCI indicator pointing upwards above the minus 100 level, it's a sign for you to possibly exit your sell trade. Okay, and then as for setting stop losses, it's important that you set your stop loss at an appropriate level. So when you enter a sell trade, for example, you can consider setting your stop loss right above the swing high, just the previous swing high, okay, or above the nearest resistance level. That should be good for setting your stop loss. Then on the other hand, as for your buy trades, when you enter a buy trade, you can consider setting your stop loss just below the swing low, the previous swing low, or below the nearest support level. Okay, that's going to be a good spot to set your stop loss. And then your take profit levels can be at the nearest support or resistance zones. Take profit levels are important for you to set, okay, so that if the market begins to go against you, at least it could have gotten towards your direction first before it begins to go against you. However, you can also consider trailing your stop loss, yeah, so that in case of if the market reverses just after some pips into your direction, you're still going to lock in some profit. You can also consider using other indicators for additional confirmation as for setting your stop losses and your take profits. Okay, then as for your exit signals, remember we've already talked about the crossovers, using the bullish signal for your for exiting your sell trades and using the bearish signal to exit your buy trades. Okay, so basically that is how it works. Okay, so I hope you found this video insightful. Kindly like and subscribe for more trading insights. Thanks for watching and happy trading.